Hey folks, it's Kevin. In this video, we're talking about credit scores. What bureaus report when applying for a home loan, how to calculate what your credit score is, and ultimately how to increase that credit score if you're not at a minimum credit requirement yet. Let's get right into it. So the first thing we're going to talk about is what credit bureaus actually report when applying for a home loan. So there's three different credit bureaus. It's going to be Experian, Equifax, and TransUnion. And it's important to know that when you go to apply for a mortgage loan, they're going to pull all three credit bureaus. They're going to look at what your score is for each one of those bureaus individually, and then they're going to consider you credit qualified based on the median score of those three. So if you have an 800, a 700, and a 600, your qualifying score is going to be 700. If you are married, if you're legally married, they're also going to consider your spouse's credit. And let's just say that your spouse's credit is lower than yours. Your qualifying credit score is 700 and your spouse's is 680. They're going to use the lower of the two. So it's important that you know where your credit is and you know which credit bureaus and how they have calculated your scores. Now that we talked about the three credit bureaus that report, let's talk about the minimum credit requirements and where you're going to want your credit to be when applying for a home loan. In most loan programs, the minimum credit requirement is going to be a 620 FICO score. So remember, that's going to be the median of the three credit scores that report. Now, you can probably go lower than this, and I've mentioned this in other videos. However, anytime you go below a 620, then you're probably going to have to do what's called a manual underwriting approval, which basically means that you're going to have compensating factors such as higher than traditional income or lower than traditional debts. And the last thing that I want is for you to have to put in a very large down payment just to make up your credit. So what I'd rather you do is work on getting your credit to a 620. And that way, when you go to apply for a home loan, you know that you're not going to have to come in with any additional down payment than what is required, unless you choose. In addition to knowing what the minimum credit requirement is, you should know that if you have a 740 FICO score, you're going to be in the top tier of credit qualifying, meaning that even though you're fighting to get a 750, 760, or even 800, it's not really going to matter because the interest rate that's offered to you is already going to be the best interest rate offered at a 740 and above. Okay, now let's talk about how you can calculate your credit score so that way you can A, understand where your position is, but B, understand how to better that position in order to qualify for a better interest rate when you do go to purchase a home. So there are a couple factors when it comes to credit that you should consider, and we're going to be talking about the percentage of influence those factors have on the overall score. The first thing that you're going to want to know is on-time payments, and this is very easy. All you're going to do is look at how many payments you have made to that credit account. And for the sake of this example, we'll just use a credit card. Let's say you opened a credit card in January of 2020. Well, at the time of this recording, we're in February 2021, and it's likely that you only made one payment this year, but you made 12 in 2020. So you had a total payments of 13, being 12 in 2020 and 1 in 2021 so far. How many on-time payments have you made? If you've made 13, well, congratulations, you're at 100% on-time payment. If you've made 12, then what you're going to do is you're going to take 13, divide that by 12, and then you're going to get your overall percentage of on-time payments. And this overall percentage, based on Credit Karma, states that if you're anything less than 99%, you're in a yellow tier, which basically means that you're going to get hit negatively because you have made less than 99% of on-time payments. On-time payments are huge because they're actually made up of 35% of your total credit score. So when considering credit factors, this is going to be number one on the list. The second most important credit factor is going to be your utilization rate. The best way that I can explain this is what are you allowed to spend up to? Meaning if you have credit cards, what is your total credit limit between all of those cards combined, and how much are you using on a monthly average? So let's just say, for the sake of this example, you have $10,000 in credit limit between all of your credit cards. And on average, you carry a balance of $5,000 monthly. In that case, your utilization rate is going to be 50% because you're using 50% of the total credit limit. Now understand that in order for you to get the best credit rating in regard to that credit factor of utilization, you're going to want to keep your balances under 10%. They say that good is under 30%, but great is keeping those balances under 10%. So if you have a $10,000 credit limit, make sure that you aren't spending more than $1,000, or at least you're not carrying more than $1,000 on that statement balance. I always encourage you to pay off all of your credit cards in full every single month, but if you are going to carry a balance, then don't allow that statement balance date to reflect more than 10%. The third most important credit factor is going to be the average length of your credit history. In order to calculate this, you're going to look at your active and open trade lines. Now let's say you have 3 credit cards, one of which was opened in 2015, one was opened in 2018, and the most recent was opened in 2020. What you're going to do is you're going to add those 3 numbers together and divide by 3. And that's going to give you a result of 2018, meaning that even though you established your first credit card in 2015, you've always been on time and you've kept that balance under 10% consistently for 6 years. Unfortunately, because you opened a recent account in 2021, your average history is going to be 2018. Now understand that this is going to be 15% of your total credit score, but there's a catch. Considering that you just opened a new account in 2021, it's likely that that increased your total credit limit, which as a result reduced the total utilization that you're using amongst all those cards. And even though average length is 15% of your total credit score, utilization ultimately is 35%. So you have to be aware that even though you might be taking a step back, you might also be taking 2 steps forward. Another thing to consider though with active trade lines is they're going to want you to establish different types of credit as well. So credit cards are what's called a revolving credit line, meaning that you have a credit limit that you can pay up to, you then pay it off, and then you're back to zero. So you're pretty much recycling that credit, you can use it and you can pay it off. Versus an installment loan, which is going to be similar to a car loan, a mortgage, or a student loan, where you actually have a start and an end date. It's important that you not only have revolving credit, but you also have installment credit lines as well. And in order for you to get the highest rated credit score, you're going to want to make sure that you have a combination of different types of trade lines, so that way the credit bureaus know that you're a responsible borrower. The last remaining 10% to make up your overall credit score is going to be hard inquiries. I know there's a lot of misinformation in regards to applying for new trade lines and having hard inquiries reflect on your credit report. However, these are some things that you should consider. Hard inquiries will only stay on your credit report up to 24 months. However, they will not negatively affect your credit score after 12 months. Similarly to the other credit factors, if you are approved for that application, what's going to happen is ultimately you're going to open up more of a credit limit, reducing your utilization. So even though you're negatively affected by 10% of that overall credit portfolio, it might be worth doing considering that utilization is worth 35% of that overall credit portfolio. So just some things to consider. Now that we know how credit scores are calculated, let's talk about some tips for people who are just getting started in their credit journey and or somebody who's maybe not in the best position as far as where their credit score is right now and they're looking to improve their score. My first tip for you would be to open up a secured credit card. You can do this at the bank or credit union where you currently hold your checking account. If you don't have a checking account, then I would encourage you to open one up. Just choose any bank or credit union, do your research online as far as which is the best fit for you. When you go there, you can apply for a secured credit card by putting down a deposit. And for me, when I was early on in my credit journey, I went through my bank, I gave them $500 and they opened up a trade line for me. After about 6 months of holding on to that card, always paying it on time and keeping my balances under 30%, they upgraded my card to an unsecured credit card and they gave me that $500 back that I initially put down as a deposit. I believe that they upgraded my credit limit to about $1,000 to $2,500, but at that point, I had my cash back in my bank and I can continue using my credit card just as a normal human being with a normal credit card. Tip number 2, if you aren't getting approved for credit cards and your bank or your credit union aren't allowing you to apply for a secured credit line, then I would add myself as an authorized user to a friend or a family member's credit account. Now, prior to asking just anybody, you want to make sure of a couple things. You want to make sure that they've had that account open for at least 10 years, that they've never been late, they've always made on-time payments, and that they keep their balances under 30%. If they've accomplished those things over the last 10 years, then they're gonna have a really good credit history. And because of that, if they add you as an authorized user, then in the next reporting cycle, which is typically about 30 days from the time in which they add you as an authorized user, you're going to see that credit line reflecting on your credit report, and you're going to adopt all of that credit history. This is a good way to get a head start on building out your credit, and it might even allow you to open up new credit lines because now you have established credit. Lastly, just a couple things that you should be aware of is don't keep balances on your credit cards. By paying interest on a credit card, it's not going to change the credit reporting, it's not going to give you bonus points, and it's not going to increase your credit score. All you're going to do is end up paying interest at the end of the month, and it's going to cost you more money. So just pay off those balances in full if you can. The second thing is do not close out old credit accounts. I understand that this is misinformation with people thinking if I had derogatory items or a lot of 30-day lates on a previous credit card, if I close it, it'll clean up that area of my credit. Now this is not true. If you close out any trade lines, it'll still report on your credit for 10 years. So it's important that you don't close it out, because what you're going to do is actually negatively affect yourself by reducing the average length of credit history that you have in total. So I hope that this helped, guys. If you have any questions, feel free to drop a comment down below. If you like this video, please hit the like button. And if you have a friend or a family member who can benefit from it, as always, send it to them. Lastly, if you could subscribe to my channel and be a part of these videos and this ongoing journey that I have in relation to credit, real estate, and things personal finance, I thank you so much for watching the entirety of this video, and I'll see you in the next one.